Hello everyone, welcome to EPK Capital. Here we simplify wealth management and investments so you can build wealth for generations. As a bonus, I have created an in-depth guide to the 7 costly tax traps for high net worth NRIs, a strategic report on avoidance and compliance. You can download it simply by clicking on the link in the description. Let's get started now. Today is December 11th, 2025, and if you thought the markets were heading into a quiet end-of-year cruise, think again. The last 24 hours have delivered one of the most critical macro events of the quarter, an event that sent the Dow soaring and has completely reshaped the outlook for 2026. We are diving deep into the massive fallout from the Federal Reserve's final rate decision of the year. We'll break down the key index levels, analyze the Fed's new economic projections, uncover the major political commentary rattling the media sector, and check in on a huge deal brewing in the crypto space. Let's get straight to it. To understand the impact, we must first look at the scoreboard. Yesterday's trading session, dramatically impacted by the 2 p.m. Eastern Standard Time FOMC announcement, closed out decisively in the green. Here are the final closing levels for Wednesday, December 10th. The Dow Jones Industrial Average. The blue chip index was the clear outperformer, surging nearly 500 points, or 1.1%, to close at a robust 48,057.75. This put the Dow at its highest level in almost a month. The S&P 500, the benchmark index, also saw strong gains, advancing 0.7% to finish at 6,886.68. Crucially, the S&P 500 missed setting a new all-time closing high by fewer than 5 points, a clear signal of extreme bullish momentum. The Nasdaq Composite, the tech-heavy index, saw a more muted, but still positive, move, rising 0.3% to close at 23,654.16. The slight underperformance here suggests a rotation out of some of the mega-cap tech names that have driven the AI rally this year and into broader, perhaps more cyclical, parts of the market. Fixed income, the closely watched 10-year Treasury yield, which had ironically risen earlier in the day, slipped to 4.15% from 4.19% on Tuesday, reflecting the market's relief and expectation of an easier monetary policy path. The takeaway is clear. The market got the news it was hoping for. But what exactly was that news? All eyes were on the Federal Open Market Committee, or FOMC, meeting, and the Fed delivered a powerful 1-2 punch that sent financial assets flying. The rate cut as widely expected by the market, with a 90% probability, according to the FedWatch tool. The Federal Reserve announced its third interest rate cut of the year. The committee voted to lower the target range for the federal funds rate by 25 basis points, bringing the new range down to 3.5% to 3.75%. While the cut itself was priced in, the context of the vote was telling. We saw some significant internal disagreement, with 3 regional Fed presidents dissenting. 2 preferred no change, signaling caution about underlying inflation, and 1 preferred an even larger 50 basis point cut, highlighting concern over the labor market. This shows the tightrope the Fed is walking right now. Chairman Powell's commentary and the dot plot, the true catalyst, however, wasn't the cut. It was the accompanying rhetoric and the updated economic projections, the famous dot plot. Chairman Jerome Powell's comments were decidedly dovish. He seemed to definitively rule out a near-term rate hike, stating, "I don't think that a rate hike is anybody's base case at this point." This single statement reassured investors who were worried about a potential policy mistake that could derail the economic soft landing. The updated summary of economic projections, or the dot plot, provided the crucial forward guidance. Growth projections. The Fed subtly upgraded its outlook for 2025 GDP growth to a median of 1.7%, up from 1.6% in September, signaling confidence that the economy can handle the current rate levels. Unemployment. The projection for the unemployment rate was also slightly revised up for 2025 to 4.5% from 4.4% previously. This is a critical factor, as a loosening labor market gives the Fed cover to continue easing. Future rate path. This is the big one. The median forecast for the federal funds rate in 2026 implies more cuts are coming. This expectation of further monetary easing is what fueled the Santa Claus rally, anticipation, and drove that significant move in the Dow. The Treasury yield disconnect one final, critical macro observation. Earlier in the day, the 10-year Treasury yield hit a 3-month high of 4.21%. Why would yields rise ahead of an expected rate cut? Market analysts point to three main drivers: rising government debt levels, a still uncertain long-term inflation outlook, and, critically, growing political tensions threatening the Federal Reserve's independence. It's a disconnect that highlights an underlying structural concern in the financial system, even as short-term policy provides a tailwind. Beyond the Fed, the political arena provided a major headline, particularly one that is directly impacting the media and communication services sectors. We saw significant political commentary regarding the highly contentious, multi-billion-dollar battle for Warner Brothers Discovery. President Donald Trump weighed in, signaling antitrust concerns over the reported $83 billion takeover bid by Netflix. This is a powerful signal that the deal could face serious regulatory headwinds in the U.S. from the next administration. Simultaneously, the political scrutiny is intensifying in Europe. The European Union's antitrust chief, Teresa Ribera, commented that the European Commission could enter to assess the deal, citing potential impacts on consumer prices and competition. This transatlantic political scrutiny signals a new phase of intense global regulatory review for massive media mergers. Investors are now forced to factor in a higher regulatory risk premium for companies involved in these large-scale consolidation plays, especially those touching core media infrastructure. For investors, this means the regulatory risk for mega-cap tech and media is not just a domestic issue. It's a global one, and it's getting louder. The crypto market, always highly sensitive to macro events, saw a significant rotation in the last 24 hours, even as Bitcoin struggled to maintain momentum following its recent massive surge. The altcoin rally, the primary story here, is the institutional flight to quality within the altcoin space, as institutional capital moves out of Bitcoin and into select, high-conviction assets ahead of a year-end. Ethereum and Solana ETPs saw substantial capital influx. Ethereum ETPs dominated the flows, attracting an estimated $117.7 million in a single day, accounting for over 60% of its total inflows for the prior week. This reflects strong institutional belief in the Ethereum ecosystem and its increasing structural scarcity. Solana ETPs also recorded robust inflows of over $10 million, continuing a multi-day buying trend, cementing its position as a favored high-beta play for institutions seeking high growth. Major corporate adoption news in a massive development for adoption. The high-performance layer, One Blockchain Say, announced a strategic partnership with global smartphone giant Xiaomi Corporation. Xiaomi will integrate a Say crypto wallet directly into all new smartphones distributed outside of mainland China and the US. The goal is a next-generation finance app powered by Say, pre-installed on new devices for stablecoin payments. This news sent the native SEI token soaring over 6% in intraday trading, highlighting the market's positive reaction to real-world, mainstream distribution partnerships. So, to summarize the last 24 hours, the final Federal Reserve decision of 2025 delivered the interest rate cut the market wanted, and Chairman Powell's dovish tone provided the momentum. This is the official starting gun for the highly anticipated Santa Claus rally. The political risk premium for media stocks just got higher with cross-continental antitrust warnings. And in crypto, institutional capital is confirming a preference for Ethereum and Solana, while a major partnership with Xiaomi signals a new phase of consumer adoption. The message for investors as we head toward the end of the year is expect volatility, but with a major tailwind now provided by the Federal. The next few weeks will be about translating monetary policy into earnings. What do you think? Did the Fed do the right thing? Let me know in the comments below. Don't forget to like and subscribe for your daily market updates. Thanks for watching, and I'll see you in the next one.